There are moments in markets when the surface looks much calmer than the system underneath it. Prices rise, charts recover, people begin to breathe again, the S&P 500 and the Nasdaq move almost straight back up in a V-shaped recovery. Bitcoin moves from the mid-$60,000 range toward $80,000. The fear that dominated only a few weeks earlier suddenly becomes less intense. The same people who were waiting for lower prices begin to feel that maybe the market has already left without them. That is how markets work. They do not wait for the world to become safe. They move when the worst expected outcome becomes a little less likely. That is why this recent rally has been so confusing. The world is not fixed. The Middle East is not stable. Oil risk has not disappeared. Inflation risk has not gone away. The Federal Reserve has not become clearly dovish. And yet the market has been buying dips aggressively, especially in large American companies, AI-related names, and Bitcoin. To understand that, you have to separate relief from resolution. Relief means the market feared one thing and then decided that the worst version of that thing may not happen immediately. Resolution means the underlying problem has actually been solved. Those are not the same thing. The market is rising because investors are responding to a temporary improvement in the probability distribution. The US-Iran ceasefire extension has reduced near-term fear of an immediate global shock. Strong corporate earnings have supported the S&P 500. AI momentum has not slowed. New models, new infrastructure spending, new corporate announcements, and continued enthusiasm around artificial intelligence have kept investors willing to pay for growth. That combination creates upward pressure, but it does not remove the risk. Oil is still elevated because supply risk around the Strait of Hormuz has not fully gone away. The ceasefire is fragile. Iran tensions have not disappeared. Reports of drone attacks and military pressure continue to remind markets that the downside scenario is still alive. Inflation has not been fully resolved. If oil stays high, the cost moves through transportation, food, goods, corporate margins, and consumer spending. So this is not an everything is fixed rally. It is a relief rally built on reduced worst-case fear, strong earnings, and AI optimism. That distinction matters because investors often mistake relief for safety. When prices rise quickly after fear, people believe the danger has passed. Sometimes it has, often it has not. The danger has simply moved from the front page to the background, and background risk still matters. This is why I would not look at the market today and say, the coast is clear. I would also not say, you must sit entirely in cash until everything is clear. Both extremes are usually wrong. The better approach is to understand the system, identify the real variables that can move prices, and build positions gradually so that you participate if the market keeps rising but still have reserves. If the market gives you another large decline, that is the balance. A person who waits for a perfect 20% correction may be right emotionally and wrong financially. The correction may come, but it is not guaranteed. If the market spends much of its time in bull market conditions and finishes positive in most years, then sitting entirely on the sidelines can be expensive during a wealth accumulation period. A person who goes all in after a rally may also be wrong. The macro risks are still real, and the market can correct quickly if oil rises, inflation reaccelerates. The Fed cannot ease, earnings disappoint, or geopolitical risk escalates. So the rational move is neither paralysis nor recklessness. The rational move is systematic accumulation with dry powder. Dollar cost average into the assets and themes with the strongest asymmetric potential and keep cash reserves for the bigger dip if the market gives it to you. This is one of the most useful investment principles because it accepts uncertainty instead of pretending to eliminate it. If prices rise, you are participating. If prices fall, you have capital to deploy. If volatility continues, you are not emotionally forced into all or nothing decisions. That is how you stay in the game. And staying in the game matters more than making the perfect short-term prediction. Markets are shaped by human beings, and human beings are greedy, fearful, impatient, and prone to overreaction. That is why prices often look irrational. People say markets are irrational, but more precisely, markets are a constantly changing reflection of expectations, incentives, liquidity, fear, and greed. Right now, the greed is returning because the worst fear did not immediately happen. The ceasefire extension made people less afraid of an uncontrollable war escalation. Earnings gave investors a reason to buy. AI gave investors a story large enough to justify paying higher prices. Bitcoin gave risk takers another way to express the same view. And once the market begins to move, the fear of missing out starts to do its work. That is why every dip feels like it gets bought. When investors believe the long-term direction is higher, they do not wait for perfect information. They buy weakness. They believe time is their ally. They believe the biggest danger is not being wrong for a week, but being out of the market during a generational technology cycle. That is the psychology of this moment. And this is why I think the real question is not whether the market can dip again. It can. The real question is whether you have a system that works whether the dip comes or not. If you are waiting in cash with no plan, you are not being cautious. You may be simply stuck. If you are buying everything without understanding the risks, you are not being brave. You may be simply greedy. A good system sits between those two errors. It identifies the major variables. It builds exposure gradually. It holds reserves. It knows what it will do if prices rise. It knows what it will do if prices fall. It does not let every headline control the portfolio. That is especially important now because there is too much information. In the past, retail investors had a disadvantage because Wall Street had better data, better terminals, better research, and faster access. Today, information is everywhere. Social media, AI tools, public filings, on-chain data, newsletters, podcasts, financial websites, earnings calls, and real-time market commentary are all available to ordinary people. That creates a new problem. The problem is no longer only lack of information. The problem is too much information. When information becomes a fire hose, the average investor becomes paralyzed. He reads one headline about war, another about oil, another about AI, another about Bitcoin, another about the Fed, another about earnings, another about inflation, another about a new token, another about a crash prediction, another about a melt-up. The mind cannot process it all, so the investor does nothing, or worse, he reacts to everything. Both are dangerous. You have to focus on the variables that actually move the needle. In the current setup, I would focus on 5. First, the conflict around Iran and the Middle East. Second, oil prices. Third, inflation and interest rate expectations. Fourth, corporate earnings. Fifth, AI optimism. If a headline does not materially change one of those 5 variables, it may be noise. That is how you filter the fire hose. Start with Iran and the Middle East. The market feared a worst-case scenario where the conflict could escalate into a broader regional or global shock. The worst version would involve a major military escalation, disruption of the Strait of Hormuz, oil tankers unable to move freely, and a direct drag on global energy supply. That is the type of event that can shock inflation, corporate margins, consumer spending, and market liquidity very quickly. The ceasefire extension reduced that fear but did not eliminate it. The United States wants several things. It wants Iran to stop holding highly enriched uranium and to stop further enrichment. It wants Iran's missile capabilities reduced. It wants the Strait of Hormuz open for oil traffic without Iranian control limits or tolls. Iran wants something different. It wants the war to end. It wants sanctions lifted. It wants compensation for damage. It wants control over the Strait of Hormuz. It wants to continue its uranium program. It wants us combat forces to leave the region and broader non-aggression commitments. Those are not small gaps. So the most likely path may be a messy middle, not all-out war, not full peace. Tensions flare, isolated incidents happen. The blockade or pressure remains. Negotiations continue in the background, markets react to each headline, but the underlying structure stays fragile. That means this risk can return quickly. You do not need to predict every event. You need to know whether the event changes the probability of escalation or oil disruption. That brings us to the second variable. Oil is the fastest transmission mechanism from war into the economy. If oil rises, inflation pressure rises. If inflation pressure rises, the Fed has less room to cut. If the Fed has less room to cut, liquidity remains tighter. If liquidity remains tighter, risk assets can face pressure. If oil rises enough, it can also hurt corporate margins and consumer spending. This is why oil is so important. It is not only an energy commodity, it is a macro switch. Oil affects shipping, trucks, airlines, agriculture, plastics, chemicals, and household budgets. It moves through the system faster than many people realize. If oil cools and moves back toward pre-conflict levels, that would support the bullish case. Inflation could remain more contained. The Fed may eventually gain more flexibility. Consumers may feel less pressure. Corporate margins may be less at risk. Risk assets may continue grinding higher. If oil stays elevated or breaks higher, the correction risk rises. This is why I would not ignore oil, even if I were investing in technology or crypto. Oil can suck liquidity out of risk assets by forcing inflation higher and delaying easier policy. The third variable is inflation and interest rates. Risk markets love lower rates because lower rates make future earnings more valuable, borrowing cheaper, and liquidity easier. If the market begins pricing a higher probability of rate cut, stocks and crypto can move before the cuts actually happen. Markets do not wait for the rate cut itself. They price the probability. That is why even talk of a more dovish policy path can support risk assets. But inflation is the constraint. If oil keeps inflation hot, the Fed cannot easily cut. If the Fed cuts into inflation, the bond market may lose confidence. If rates stay high, borrowing stays expensive, housing remains strained, consumers remain pressured, businesses delay hiring and investment. So inflation is not just an economic statistic, it is the gatekeeper for liquidity. The source discusses Jerome Powell eventually leaving the chair position and Kevin Warsh replacing him. Whether the exact timing and policy path unfold as expected, the market's focus is obvious. Investors want to know whether a new Fed leadership structure makes rate cuts more likely, even if cuts do not come immediately. Rising probabilities can move prices early. Again, markets are forward-looking, but the forward-looking view can change quickly if inflation data or oil prices move the wrong way. The fourth variable is corporate earnings. This is the anchor underneath the rally. A market can rise on liquidity and narrative for a while, but earnings matter. If companies keep generating profits, investors have a reason to buy. If earnings expectations rise, the market can justify higher prices even when macro conditions are imperfect. The source points to stronger earnings growth expectations for the S&P 500. That matters because it tells us the rally is not only about war relief, it is also about companies still making money and analysts expecting more profit growth. As long as earnings remain solid, the market has support. If earnings begin to weaken, the rally becomes more fragile. The fifth variable is AI optimism. This may be the strongest structural force in the market. AI is not only a product cycle, it is a capital expenditure cycle, a productivity story, a labor disruption story, an infrastructure story, and a platform shift. Investors are trying to price what happens when software becomes more capable, data centers expand, chips become more important, and companies use AI to reduce costs or create new products. The market still trades on whether investors believe the AI trade remains intact. When a headline appears suggesting that AI is cheaper, more competitive, or that China may be ahead, the market can panic. We saw this with a DeepSeek-related sell-off where NVIDIA and other AI names were hit quickly. A single perceived threat to the AI infrastructure thesis can wipe out hundreds of billions of dollars of market value in a short time. That tells you how important the narrative is. AI optimism supports the market. AI doubt can shake it. That is why every new model, every infrastructure announcement, every data center capex plan, every major AI spending commitment, and every cost breakthrough matters. The source mentions companies committing hundreds of billions of dollars to AI infrastructure. That is not a small signal. When Google, Microsoft, Meta, Apple, and other giants commit huge sums to AI, they are not making small experiments. They are reorganizing capital around the next technological platform. That is why being completely sidelined during this period may be dangerous. If AI really is the greatest technological shift of our generation, then sitting entirely in cash because you are waiting for perfect clarity may be the wrong move. Clarity often comes after the largest gains are already made. This does not mean every AI stock is a buy. It means the structural theme is too important to ignore. Now, the deeper reason this moment matters is not only market prices. It is labor. The source emphasizes that major technology leaders are discussing forms of universal basic income, universal high income, or universal basic wealth, because AI may displace many jobs. Elon Musk has spoken about government checks as a way to handle unemployment caused by AI. Sam Altman has discussed forms of wealth distribution tied to AI abundance. Policymakers in other countries are studying UBI for workers displaced by AI. You do not need to agree with every proposal to understand the signal. When the people building the technology begin discussing how society handles mass labor displacement, you should pay attention. They are telling you that the future work structure may look different from the past. This is not guaranteed to happen quickly. It may take 5 years, 15 years, or longer. There may be new jobs created, productivity may rise, wages may adjust, regulation may intervene, but the possibility is real enough that a rational person should prepare. There are two broad outcomes for the individual. In the first, you do nothing. You become mainly a consumer in someone else's economy. The machines are owned by others. The platforms are owned by others. The assets are owned by others. If AI reduces job opportunities, you depend on wages that may not keep up or on government support designed by policymakers. In the second, you prepare. You own pieces of the system. You invest in productive companies. You hold assets that can benefit from the technological shift. You diversify across stocks, Bitcoin, gold, international exposure, and growth opportunities if they fit your risk profile. You build skills. You reduce dependence on one paycheck. You become an owner, not only a laborer or consumer. That is the real wealth transfer. Not because money automatically moves to everyone, because those who own the productive assets of the next system may benefit enormously, while those who only consume may fall behind. This is a hard truth, but it is not new. Every major technological shift creates winners and losers. The Industrial Revolution did, the internet did, mobile did, cloud computing did. AI may do the same, but at larger speed and scale. The question is not whether the game is fair. The question is whether you understand the game and position yourself intelligently. Complaining about the game does not change it. Understanding the game gives you options. That is why financial security matters so much. Money does not solve all problems. It does not create ultimate fulfillment. It does not replace faith, family, health, meaning, or character. But money does affect the school district your children attend, the neighborhood you live in, the medical care you can access, the freedom you have to leave bad situations, and the size of problems that become crises. Financial strength turns many large problems into manageable problems. That is why ownership matters. Now let us talk about asymmetric opportunity. A truly asymmetric opportunity is not just something that can go up. Everything can go up. Asymmetry means the upside is large relative to the downside, and the probability of the upside is not yet fully priced by the market. The best opportunities often have several factors aligning at once. A strong narrative before the crowd fully understands it, a place where attention is about to move, a place where liquidity can flow, a limited downside relative to the potential upside, evidence of relative strength during uncertainty, a catalyst that can bring new buyers, a market that has not yet fully priced the change. This is the framework. The source uses Aerodrome as an example. The core lesson is not simply that one token went up. The lesson is how the opportunity was identified. A major platform was planning to bring users and financial products onto a new chain. The narrative was forming before the crowd cared. There was a token that gave exposure to that ecosystem. The upside was large. The attention had not yet arrived, and the market still believed crypto was dead. That is how major asymmetric trades often look. They do not look obvious to everyone at the start. If they did, the price would already reflect it. The trade may even go down after you buy. That does not automatically mean the thesis is wrong. If the thesis is intact and the decline is caused by temporary market stress, a disciplined investor may add. But that requires conviction built from research, not blind hope. Conviction is not yelling louder. Conviction is knowing why you own something, what would prove you wrong, where the downside is, and what conditions must occur for the upside to play out. That is why research matters. The best investors are not simply lucky. They often understand a system before the crowd does. They know where attention will go. They know where liquidity will go. They know which asset gives exposure. They know whether the market has priced it. That is the essence of asymmetric investing. Now, the current environment is difficult because markets are choppy. We are not in a clean, obvious bull run where everything moves together. In a strong bull market, almost anything with a narrative can rise. In a choppy market, capital rotates, one sector moves, then another, one token runs, then liquidity shifts, winners appear one by one, not all at once. That makes selection harder. It also makes watch lists more important. You should not blindly buy everything that is green. You should build a list of assets and narratives that have strength, catalysts, and upside. Then you wait for the market condition to align. That is important because most of the year is noise. There are only certain windows where the high time frame trend and the short term trend align. During those windows, opportunities can move quickly. Outside those windows, overtrading can destroy capital. The source uses a fishing analogy, and I think it is useful. There are times when the fish are biting and you can cast almost anywhere with a decent setup and get action. There are other times when the water is pressured, the conditions are poor, and you can spend hours forcing trades that are not there. Markets work similarly. There are conditions for aggression. There are conditions for patience. The mistake is using the same behavior in both. When the trend is clear and liquidity is flowing, you can size with more confidence if your system supports it. When the market is choppy and uncertainty is high, you prepare, research, build watch lists, and avoid wasting capital on every small signal. Patience is not inactivity. Patience is preparation without forcing. Now, one unconventional signal mentioned in the source is attention. Retail attention often returns at the worst time, when retail loses interest, when views fall, when people stop watching market videos, when sentiment becomes exhausted. It can signal that many people have stepped away from the opportunity. When everyone comes back excited, it may be closer to the time to reduce risk. This is not a perfect indicator, nothing is, but it reflects a real market principle. The crowd often wakes up after the best early moves. If you can study while the crowd is asleep, you may have an edge. That does not mean do the opposite of the crowd blindly. The crowd can be right for a time. But when crowd attention, liquidity, narrative, relative strength, and valuation all line up, you can get clearer signals. A single signal is weak. A confluence of signals is stronger. That is the word to understand. Confluence, narrative plus liquidity plus relative strength plus catalyst plus reasonable valuation plus low attention, is much stronger than one factor alone. Now, let us talk about Bitcoin. Bitcoin remains one of the central assets in this setup because it sits at the intersection of risk appetite, liquidity, institutional adoption, digital scarcity, and macro distrust. The source uses levels around 70,000, 60,000 to 70,000, 50,000, and 80,000 to 82,000 as decision zones. The exact numbers are less important than the process. The process is mechanical. If Bitcoin remains above a key level, the thesis is intact. If Bitcoin enters a lower support zone, the investor can add gradually. If Bitcoin gives a deeper panic opportunity, that may be a stronger accumulation zone. If it breaks through confirmation levels, it may signal an early breakout. This is not prediction. It is conditional planning. If this happens, I do that. If that happens, I do this. That is how you avoid emotional decision making for many investors. Bitcoin should remain a measured position, not the entire portfolio. It can grow when the thesis works, and it can shrink relative to other assets when rotations move elsewhere. Bitcoin can be a core crypto exposure, but the amount depends on risk tolerance, experience, net worth, time horizon, and whether the investor can survive volatility. Leverage is especially dangerous. The source mentions using leverage in certain deep drawdown opportunities, but also makes clear that this is personal and not for inexperienced people. That distinction matters. Leverage can multiply gains, but it can also destroy an account quickly. In volatile assets, leverage must be handled with extreme discipline or avoided entirely. Most people do not need leverage to build wealth. They need consistency, position sizing, and time. Now, beyond Bitcoin, the source focuses heavily on hyperliquid and hype. The thesis is that hyperliquid is not just another crypto exchange. It is becoming a high-revenue, high-usage trading infrastructure layer. It has significant annualized fees, significant annualized earnings, billions in total value locked, and very large monthly perpetual volume. It has deep liquidity and a meaningful value accrual mechanism because a large portion of revenue is routed back into token buybacks. This is important because crypto narratives often lack real usage and real revenue. Many tokens are simply stories. Hyperliquid's appeal is that there is visible on-chain activity, fees, and usage that can be tracked in real time. That does not make it risk-free, but it makes it different from a pure meme or vaporware project. The more interesting part is the expansion beyond crypto with upgrades that allow permissionless deployment of new perpetual markets. Hyperliquid can become a venue for 24/7 trading of assets like oil, gold, silver, indexes, and individual equities. If traditional assets can trade on-chain at all hours with deep liquidity, the total addressable market changes. The platform is no longer only for crypto traders. It begins moving toward a broader financial exchange layer. That is a major narrative if it continues. Coinbase adding native USDC support on HyperEVM also matters because stablecoin access and trusted fiat on-ramps can make usage easier. A trading platform becomes more powerful when capital can move in and out efficiently and when users already trust the liquidity. The next potential catalyst is HIP-4 and permissionless prediction markets. Prediction markets have grown significantly, and platforms like Polymarket and Kalshi have shown that people are willing to trade outcomes, not only assets. If Hyperliquid can integrate prediction markets into an existing high-volume trading environment with margin and perpetual positions that could expand fee generation again, and if fees expand while buybacks continue, the token economics may improve. That is the bullish thesis. But there is also a bear case, and it must be taken seriously. Validator decentralization is a major concern. If the network can run only a small number of validators, then the system is still centralized in a way that matters for long-term credible neutrality. Crypto infrastructure depends on trust, but not trust in a person. It depends on the system being resilient, neutral, and resistant to capture. If decentralization remains too weak, that can limit the institutional or philosophical appeal of the network. So the thesis must be monitored: revenue, volume, TVL, buybacks, prediction market adoption, traditional asset trading volume, USDC integration, validator decentralization, regulatory risk, competition. These variables matter. The source suggests hype could reach higher price targets if the thesis plays out. But I would treat any price target as a scenario, not a certainty. A 2 to 4 times move can happen in crypto. A 50% drawdown can also happen in crypto. The risk reward may be attractive, but only if sized correctly and managed with a system. Now let us talk about PER. PER is presented as a more leveraged or structured equity exposure to Hyperliquid. It trades on NASDAQ, not as a crypto token. It is a treasury company holding a large amount of HYPE tokens and remaining deployable capital. It also has an equity line and a repurchase program. The leadership includes traditional finance operators, including Bob Diamond as chairman, which may help bridge crypto and public markets. The idea is that PER gives public market investors exposure to Hyperliquid's upside through an equity wrapper. This is similar in spirit to how MicroStrategy became a public market Bitcoin exposure vehicle, though the structures and underlying assets differ. The key with any treasury company is net asset value, premium or discount, leverage, dilution, governance, and the quality of the underlying asset. If PER trades near NAV, there may not be a major discount. If it trades at a premium, investors must ask why that premium exists and whether it can be sustained. If it can raise capital accretively and accumulate more hype, it may benefit. If the underlying token falls or the premium collapses, the equity can fall sharply. Treasury companies can be powerful in risk. On environments, they can also be dangerous if liquidity disappears. So PER is not a simple replacement for hype. It is a different structure with different risks. That distinction matters. Now let us talk about MicroStrategy. MicroStrategy is one of the clearest examples of a public equity wrapper around Bitcoin. If you are bullish on Bitcoin and want leveraged public market exposure, MicroStrategy has historically amplified Bitcoin moves because of its large treasury holdings and capital strategy. The thesis is simple. If Bitcoin rises, MicroStrategy can rise more. If Bitcoin falls, MicroStrategy can fall more. That is leverage. Michael Saylor's company has accumulated a very large amount of Bitcoin and has openly expressed the desire to keep accumulating more. Large institutions have issued high Bitcoin price targets for future years. If Bitcoin moves toward those targets, MicroStrategy may benefit significantly. But the risk is also obvious. MicroStrategy is not just Bitcoin. It is Bitcoin plus balance sheet engineering, market premium or discount, debt structure, equity issuance, and investor sentiment. If Bitcoin falls hard, the equity can fall harder. If the market loses appetite for treasury companies, the premium can compress. If financing conditions worsen, the strategy may become more difficult. This is why MicroStrategy may be attractive for some investors and too risky for others. It is not a conservative asset. It is a leveraged risk expression. Know what it is. Now let us talk about Pengu. Pengu is presented as a meme coin or consumer crypto allocation. Every crypto cycle seems to produce a high-cap meme or culture coin that captures retail attention. Dogecoin did it. Shiba Inu did it. Other meme assets have done it. The thesis is that Pengu sits at the intersection of liquidity, brand product market fit, Web 2 recognition, community, and narrative. This is a very different kind of investment from Bitcoin or Hyperliquid. Bitcoin has a scarcity and macro thesis. Hyperliquid has a revenue and exchange infrastructure thesis. Pengu has a brand, culture, attention, and retail flow thesis that can be powerful in crypto because attention itself becomes liquidity. When a meme asset captures the public imagination, prices can move far beyond what traditional valuation would justify. But the risk is extreme. Meme coin volatility is brutal. Dilution of attention is real because new coins appear constantly. Pump and dump behavior is common. Retail can disappear quickly, narratives can die overnight. So a meme coin allocation must be small, tactical, and understood as high risk. It may be a watch list trade rather than a long-term core position. If the broader market narrative returns and retail attention comes back, assets like this can move fast, but they can also collapse fast. The goal is not to confuse a meme with an investment foundation, The goal is to understand whether there is a small speculative opportunity that fits within a broader risk system. Now let us talk about BMR. BMR is described as a trade connected to Ethereum exposure, with Tom Lee as a visible public face and large funding behind the structure. In every cycle, charismatic figures, strong narratives, treasury strategies, and large capital pools can create powerful public market vehicles. If Ethereum becomes relevant again in a risk-on cycle, a levered public equity or treasury vehicle tied to Ethereum can attract flows. Again, the structure matters. What does BMR actually hold? What is the percentage exposure? How does it trade relative to NAV? How much funding does it have? What are the catalysts? What is the dilution risk? What is the relationship between Ethereum price and the equity price? Who are the backers? How does it behave in risk? Off conditions, the source says to add it to a watch list because it may run when markets return. That is a reasonable framing watch list. First research first, conviction first, position later. Do not buy only because a name is mentioned. Build the thesis. Now let us step back and put the crypto playbook together. Bitcoin remains the core macro crypto exposure. MicroStrategy is leveraged public market Bitcoin exposure. Ethereum and Solana may remain major ecosystem plays in the next bull run. BMR may provide a levered Ethereum-related public market expression. Hype may be the high-conviction altcoin infrastructure play if Hyperliquid continues growing volume, fees, and value accrual. Per may be a public market structured play on Hype and Hyperliquid's treasury strategy. Pengu may be the meme or consumer attention play if retail comes back. This is a diversified crypto opportunity map, but it is still high risk. Every one of these can fall sharply. That is why position sizing matters more than excitement. If you are early in wealth accumulation and willing to take high risk, you may allocate differently than someone already preserving wealth. If you have already made money, the goal may shift from maximum upside to wealth preservation plus selected upside. That distinction is important. The investor's stage of life should determine risk. A person trying to turn a small portfolio into something meaningful may accept more volatility. A person protecting seven figures should think differently. The same asset can be suitable for one person and unsuitable for another. Now let us talk about selling. Buying early is hard. Selling is often harder. People think the challenge is finding the entry. But in crypto especially, exits are psychologically brutal. When an asset rises, greed expands. A 2 times becomes not enough. A 5 times becomes a stepping stone. A 10 times makes the investor believe a 50 times is coming. The mind begins rewriting reality around the gains. Then the reversal comes. If there is no exit plan, paper gains can disappear. This has happened in every crypto cycle. The source is correct that selling can be harder than buying. That is why the exit plan should be written before the mania. Take profits at levels, reduce risk when the crowd returns. Understand that not every position must be held forever. Separate core holdings from trades. Know which assets are long-term and which are cycle trades. Bitcoin may be a longer-term core for some people. A meme coin may be a trade. A treasury company may be a cycle vehicle. An altcoin infrastructure token may be somewhere in between, depending on adoption and fundamentals. You need categories. If every asset becomes never sell, you may ride winners back down. If every asset becomes sell at the first profit, you may never capture asymmetric upside. That is the balance. Now let us talk about conviction and grounding. Conviction is necessary because volatility is intense. Without conviction, you will sell the first drawdown and chase the first pump. But conviction must be rooted in research, not identity. A person who becomes emotionally attached to an asset stops updating. A person with true conviction can still change his mind when the facts change. That is a critical distinction. Bad conviction says, I will never be wrong. Good conviction says, I know why I believe this, and I know what would make me reconsider. That is how to stay grounded. Markets will stress you, crypto will stress you even more. You need something deeper than price to keep your mind clear. For some people, that is faith. For others, it is principles, family, discipline, meditation, health, or a written plan. The source ends with the importance of being rooted in something that creates peace and clarity. That is not a small point. When markets move fast, your emotional state becomes part of your investment process. A panicked mind makes bad decisions. A euphoric mind makes bad decisions. A grounded mind has a chance. You need clarity because the next several years may bring some of the biggest technological and financial changes of our generation. AI, robotics, automation, crypto infrastructure, government support systems, energy pressure, geopolitical conflict, inflation, and liquidity cycles may all interact. It will be noisy. The people who filter noise, own assets, and make disciplined decisions may do very well. The people who doom scroll, gamble randomly, and never build a system may become liquidity for others. That is harsh, but markets are harsh. The market does not reward confusion. It rewards preparation, patience, and correct risk taking. Now, what should the practical strategy be? First, accept that the market can keep going higher even if risks remain. Second, accept that another correction can still happen. Third, DCA into your strongest long-term themes. Fourth, keep cash reserves for a bigger dip. Fifth, focus on the 5 needle movers: Iran, oil, inflation and rates, earnings, and AI optimism. Sixth, build watch lists around asymmetric opportunities. Seventh, Do not buy everything that is green. 8th, wait for confluence, narrative, liquidity, relative strength, catalyst, and upside. 9th, size. According to your stage of life and risk tolerance. 10th, have an exit plan before the crowd returns. This is a system. It will not make you perfect. No system does. But it is better than emotional reaction. If the market goes higher, your DCA participates. If the market dips, your cash gives you the ability to add. If AI continues to transform the economy, your ownership matters. If crypto enters another risk, on cycle, your watch list is ready. If geopolitical risk returns, you are not surprised. If oil rises and creates another correction, you know why. That is how you move from being a passive consumer of headlines to an active allocator of capital. Now, let us address the phrase, last chance at generational wealth. It is powerful, but it must be handled carefully. There is never only one last chance in markets. Opportunities come in cycles. There will be future technologies, future crashes, future booms, future assets, future mistakes by the crowd. But some moments are unusually important because multiple large forces align. AI, crypto adoption, on-chain finance, Bitcoin institutionalization, labor disruption, and liquidity cycles may be aligning. Now that makes the opportunity meaningful. But calling something generational should not make you reckless. The best way to miss generational wealth is to blow up before the opportunity matures. Leverage too much, concentrate too much, chase too late, sell too early, never sell at all, ignore risk, ignore research. Follow influencers blindly. Those mistakes destroy the very upside people are chasing. A generational opportunity requires generational discipline. That means you must survive, you must stay solvent, you must keep learning, you must keep reserves. You must take enough risk to benefit, but not so much risk that one drawdown removes you from the game. That is the balance most people do not want to hear. They want the ticker, they want the target, they want the shortcut. But the real shortcut is having a system before the crowd returns. Now let us close with the main idea. The market rally is real, but the macro risk is not resolved. The ceasefire has reduced immediate fear, but the Middle East remains fragile. Oil is still the fastest risk transmission mechanism. Inflation and rate cuts remain connected to oil and policy expectations. Earnings remain strong enough to support stocks. AI optimism remains the largest structural force behind the market. Bitcoin and crypto are participating, but volatility will remain extreme. The right response is not to wait helplessly for the perfect crash and not to chase blindly after the rebound. The right response is to DCA into high-conviction, long-term assets, hold reserves for deeper drawdowns, and prepare watch lists of asymmetric opportunities where narrative, liquidity, attention, and fundamentals can align. Bitcoin remains a core crypto exposure for many. Hyperliquid may represent one of the most important exchange infrastructure stories if the revenue, volume, and value accrual continue. Per may offer a public market wrapper around that thesis, but with different risks. MicroStrategy remains a leveraged Bitcoin equity play. Pengu may capture consumer crypto and meme attention if retail returns. BMR may become a high-beta Ethereum related trade if risk appetite and narrative return. All of these require research. All of these require risk management. None of these should be followed blindly because the goal is not to copy someone else's portfolio. The goal is to understand the game before the crowd comes back to the table. If AI changes labor, ownership becomes more important. If crypto infrastructure matures, early positioning matters. If markets grind higher, being entirely sidelined becomes costly. If markets dip again, cash reserves become powerful. If retail returns late, disciplined exits become necessary. That is the system. And the people who do best in a system like this are not the people who react to every headline. They are the people who prepare while others are distracted, size risk intelligently, and act when the conditions align. Markets reward that kind of preparation. Not always immediately, not always smoothly, but over time, preparation gives you the chance to be on the right side of the wealth transfer instead of watching it happen to someone else.